Hi, Warriors. Who's ready to react to the NFP? Hi, Alexander. I'm getting an echo. Hello, Michael. And Bran came in. Sinatra and Ryan.
Are you ready, Dale?
What the heck is that?
Yeah,
I think we're ready. I think we're ready. So that, some dramatic music. Thought I'd start off with TLT. It's probably nothing but a sovereign debt crisis. One of the ugliest charts on my screen. They're going to come in a little better. Stel, what do you think about rates now after what happened this week?
I still think this is a spike which is going to be taking us to the top. I didn't think we'd get up here, but we still have a 433. What is it? 434, the previous high in the 10-year US. That's the hurdle, I think. If that gets taken out, then we need to reconsider. But I still think this is, for me, there is absolutely no reason for yields to be going higher with central banks stopping and with inflation dropping, and definitely not rising, at least not for the next 6 to 9 months. That's what I've been saying for a while. I see no reason. And I think this is driven by a short squeeze in the dollar, and the yields are kind of following suit. I don't see the logic in it. Clearly, the market thinks otherwise, but my view remains the same.
I guess it's a downgrade and all the supply.
Supply is one, yes. But with the downgrade, what logic is there for the dollar to be bid with a US downgrade? There's zero logic. So there's moves in the markets which can be explained, others which can't be explained. So let's wait and see what we get today.
Okay. Now let's go and talk about the yen, because the yen had a bit of a negative day yesterday from a lower peak. Why don't I start off with Ryan? Do you think that maybe we completed something up here, Ryan, yesterday at about 43.80, and we're still higher on the week, but this is where all hell would break loose in risk, initially taking out 42, and of course under 38. There's going to be, the carry trade's going to have major problems here. So your take on the yen going into the end of the week, should we be stalking shorts here?
I don't know. I think we're sort of middling of the range. That move down from 145. We're a bit higher than mid. We couldn't break lower this week through that 142.25, 142 area. I think where we are now, around this 142.80, 143, where we close this week might be important. If we close above, say, 143, then I reckon we're probably going to be heading for those 145 highs. If we close below 142, 85-ish, then we might be looking a bit bearish. But on balance, I think you probably want to be looking at a dip buy still in this one, given that the data from the US isn't rolling over. We might have just had a little bit of a wobble this week on risk, but I think we've got to favour the dip buy for the moment.
Okay, do you agree with that, K-Man?
Good morning, Dale. Good morning, everybody.
Good morning, buddy.
Yeah, on the dollar yen and some of the carry trades, let's take the MEX also as an example. We're still not at alarming levels for the longer term carry traders. But we have seen some form of unwind this week. Now, if we get, and that's an interesting one going into the NFP, if we get a really bad number and we are starting, and the markets start to think or see that the jobs market, the last big domino, is starting to fall, then I think that's going to create a big negative for the carry trades indeed. if you look at how the yen behaves right now, I've been showing that on the flow show as well. A little bit of a run through the Ishimoku cloud setups. They are still relatively positive, but if you start to break under 141, then the picture is probably going to change quite severely for the dollar yen. That on that bit. And the last thing I would like to add today is that the options market is absolutely not pricing in big swings over this jobs report. If you look at through the overnight options, the euro dollar is priced at 50-55 pips range. Even the dollar Canada on the combination of the NFP and the Canadian labor report, which usually can see big moves, it's only priced at roughly 60 points. So those are a few things. But if you talk about the carry trades, then yeah, I think if the job market in the US starts to roll over, then the carry trades are going to rush at least partially for the exit.
These are great points that you make, hey man. Sorry, I had to just jump in there. Great
that's
points.
Okay. Blake, Nikkei sitting at major support. That last pop was a failure, and you know, we pointed out, maybe it was you, the false breakout in the DAX this week. That looks ugly.
Yeah, it hit the underside of the ascending wedge. We were expecting it to reverse from there, and it did. I mean, it went literally to the pip and reversed once it hit new highs. It was the underside of that broken trend line of the ascending wedge. So you could draw it out. It goes out like in a year. So
bearish.
We've seen some pretty big reversals. I mean, look at copper. Look at Dale, I know you were without power a little bit yesterday, but have you seen the dollar Mexican peso? It
no,
breached
but
17
I know that
again.
I know that's the way you were looking to play risk off. Oh yeah, I had a nice move, and you talked about this last week when we were diverging down here.
Yeah,
it looks pretty good.
Yeah, it's really moved a lot, and I think it's starting to really, going back to K-Man's point, this is where people are starting to get worried. I met with a gentleman for the very first time. He goes by Deer Point Macro because he works at a shop factory where he has to have anonymity, because he does on the side. And we were having a discussion yesterday about emerging markets, and he works for a Canadian bank. So we were talking about emerging market currencies, and they are all shifting towards a rate cut regime. And he's, it was a really interesting conversation. I'll make sure I post it here later today. It should be out a little bit later today. But yeah, dollar Mexican peso is definitely on everybody's radar right now, for sure.
Yeah, that's a nice reversal week. So they could squeeze it. Maybe back to 19, the breakdown, 1970.
I got some thoughts there, and I'm sure we can talk a little bit about that later. I'll let you guys continue on.
Okay. Apple's earnings weren't great. Broke down from the trend. There's a weekly, and we're going to come in about 5 lower on the earnings. So you have a breakdown in Apple. There's lots of support, maybe at 170, that's a breakout. Under 170, there's problems for Apple, but that's still quite a ways away. NVIDIA's trying to bounce, but it hasn't made a new high in a month, which is unusual for NVIDIA. We'll see if we could, take it under these moving averages. We start closing under 420. There's a lot of room. Maybe even for a gap fill. No reason to rush into the metals. They still look heavy to me. And silver.
You see Amazon last night?
Amazon had a great report. I think it's about 15 higher or so coming in. And it's the one that had the weaker chart pattern between Apple and Amazon. Apple's coming off all-time highs, and Amazon, it's just been a recovery rally. So
50% retrace.
Yeah, I'd sell it on news here, but I have enough stuff on. I know this is a heartbreaker like nat gas, but we're having a decent week. Kind of looks like the peso and the VIX, and we gapped up yesterday. So it's kind of an island, because if you look at it, we also gapped down. We'll see. So, first move out of here. Here's my big picture on VIX is, this 20 area is going to be important. You have some daily moving averages up here, and you had a couple of failed attempts. We start getting through 20, then you're talking 27. That's actually a downtrend line. And we get through there, we're going to be trading 45.50. So that's
so Dale, since it's NFP day, you mind if I take over from here, buddy?
No, not at all, Blake.
All right. And by the way, you have a guest today, Michael Guyad, right?
Yeah, Michael's supposed to drop in.
Good. That'll be great. I want to talk just because we have obviously the Canadian and US data coming up. Dollar Canadian still looks really bullish into this resistance. But before I get into like kind of some of the setups here and find out what the best setups that Stelios, Ryan, Cayman, Dale, you think you can think about this as well. I wanted to start with Stelios. What are you thinking right now ahead of the jobs report?
I don't have anything that I'm looking at in particular. We are ranging in most of the things that I'm interesting. So, I did pick up some cable yesterday for people who are ForexAnalytix subscribers. 26.
You were scalping cable yesterday,
30,
and I have to say that doesn't happen often.
I know it doesn't. 26.39. I got some. I offloaded at 60 pips. That was nice, but for my major
level guy,
he was nice confluence of supports. For my major positions that I like, which I usually accumulate, nothing actually has come to any of my levels. But one thing's for sure, we are getting to a very important point in the dollar. So the Dixie 103.50, I've said that this spike should finish there. If it doesn't, then I think we'll have to reconsider pretty much everything.
So how do you feel about the bond market? I mean, here we are flirting with the, we haven't seen these levels since end of last year. So what are your thoughts?
Well, in the 10-year US, I think like Dale said, it's about supply and maybe the downgrade as well. But I tell you what, 4+% or 5+% in the very short term is very attractive. And the US is never going to default. Well, never, not in my lifetime anyway. So I think investors and non-scalpers, so more long-term traders, they are going to like these yields because I think we all know that lower rates are coming eventually. So I really don't see a scenario apart from inflation kind of ramping up again. I don't see any other scenario where yields go higher. So I've said I think we're at the top in yields. Okay, we're going a little bit higher than I thought, but then again, my timing was never perfect, was it?
Yeah. Well, I'm always like a day or two early. It feels like sometimes a week or two. So hey, Ryan, let's go to the flow show. What do you think? Well, first of all, what were you guys covering this morning on the flow show? And if you are trading during European hours, you should be listening in to Ryan, Cayman, and Stelios first thing in the morning. Well, I'm still sleeping, but what were you covering and what's on your mind going into this non-farm payroll?
Oh, well, as usual, we covered a whole ton. The Bank of England, we looked at options. Kay gave a good rundown on how to look at the option vols, which you can obviously see on our dashboard now. And obviously the non-farm payrolls and what we expect from it. And volatility is low for this event, and that's probably right, because unless we see a real big outlier number and more so a downside number in the NFP, we've seen big numbers, we've seen positive jobs numbers. There's nothing that's going to shake the tree at the moment. So the big risk is if we always do see a big number, a big miss.
What do you? Okay, you're saying big number, big miss. I mean, so you're obviously thinking maybe this is the month, right?
No, we've been saying that for the last 18 months. This is the month.
Right.
What I'm saying is the market we're expecting 200,000. If it comes in 400,000, 500,000, no one's going to bat an eye, really. Yeah, we'll get a bit of a rally in the dollar, maybe a bit of a rally in yields, but it's par for the course. We know that it's been strong. So the big price risk, every time we get a good number, the next month, the big price risk is we get a bad number, because that will shock the market. So yeah, we get a 400K, we probably see the dollar rally for 5 minutes, and then back to doing whatever else we were doing. But if you get a minus 100K, oof, I hope you've got clean pants on.
Let me ask you this, and this is where I start to get very cautious about the jobs data. I think the market is at the point that, people that have been betting on, and I'm talking, let's talk, institutional, money managers, hedge fund managers, people that have been running the bet that, like, hey, look, 2024, we're going to start getting some rate cuts. There's going to be the market, the economy is going to roll over. Fed's going to give us some rate cuts. We're buying equities here. At what point, if the data comes in strong, and let's say we have a 400,000 print would be crazy, but let's just say we get like 250,000, and let's say the average hourly earnings actually tick down as expected, right? They tick down as expected month over month. Let's say we get that, which is good, right? That's good. That's what that says, hey, no recessions here. I actually think the market's going to find that negative. But that's me. I mean, I think the market's at that point where people go, well, shit, we aren't going to get a recession. And that means the Fed isn't going to cut rates. And I don't know if I really want to own stocks up here. That's my opinion. What do you think about that?
Well, go a bit further out on your chart, and you can see the trend that we've had since September. We've come through how many jobs reports? 6, 7 jobs reports for all that, all those fears, all those worries. And what has the stock market done? Gone up. Yeah. It doesn't care. It doesn't care. It's only going to really move if we get a big miss, because, as I say, that's the big shock. So if we get an inline number, I can see the market doing not an awful lot, and then we'll win summer trading, full stop. So, but you've got, as traders, we've got to know where our big risk is. We've got to know where the big price risk is, and it's not on a decent number. It's on a bad number.
Okay. And that you make a great point. And we got about 13 minutes or so, 12 minutes until the data comes out. Let's not forget that we got reads on ISM this week. We got ADP numbers that blew out the markets. We had, the ISM data that came in strong. Both services and manufacturing that was out this week. We had the JOLTS jobs numbers. It still suggests the labor market's pretty tight. Weekly unemployment claims, didn't give us much of a change, but it just tells us the market, the jobs market's somewhat steady here. So everything that we got really points to data that's not going to be horrible. Now that doesn't mean that we're not, playing the NFP lottery today. Speaking of which, if you guys haven't played the NFP lottery, make sure you jump into, let's see, right here. Ryan, if you can grab, I don't know why this isn't refreshing because Twitter's screwed up now, but if you can grab that link to,
I'll check it in the chat.
Yeah, to, this is ForexAnalytix. Here it is. I'll put it here. Let's, you can grab it. Okay. He's going to put it in the chat box. If you guys haven't guessed the NFP, make sure you guess the NFP number, because this way you can jump in our community. This is the ForexAnalytix community. Just if you guys want to see it, this is all of us just kind of posting charts and what we're thinking, and how things are going, and kind of all the setups today that I was looking at, because right there, and you can see this is just the general chat room just from the last hour. So it's a really, really one of the most busiest and dynamic trading communities that you can find. And I just showed you the general chat room. That wasn't the trades room, the S&P room. And so not only do you get the ForexAnalytix platform, which is this, but also you'll get the chat room as well. And you guys can get that for free if you win and you guess closest. We give away 3 free months of ForexAnalytix. So make sure you guys are checking that out. or you guys go guess. I think my guess was 189, and I think there's like a lot of people in the 180s right now that are guessing that number. So that means it's going to be way different than what I guessed. Just so you all know that's how it's gonna pan out. Don't forget, we have Canadian data now. The dollar Canadian is up against resistance. Let's not forget that we are up against critical resistance. I was aggressively long down here in the lower 130s, and I've got just a full size position now. It was way more aggressive than full size, as most people in our community knew. But now that we're against resistance and we've had a nice run, we're going to have to see strong U.S. data and weak Canadian data for me to press further and for us to see higher levels near term. But I still think it looks pretty bullish here. Do you guys have any views on Canada right now and going into this Canadian data? Let's start with you, K-Man. Anything there?
Yeah, it's undeniably big. And if you look at the latest data, I'm not sure how the latest housing data were, because that was a bit of a big scare in Canada as well. But if you look at the latest data, there's not, and oil, there's not much to justify this weaker Canada, barring the higher dollar. So this it's clear that the market is trading Canada on the defensive. So I think the pricing for today is a little bit underpriced on the options market. I could see a bigger move, especially if we start to break those 133.90 levels. There's a bit of air up to the high, well, yeah, where your D point is there, like 134.60s, 570. I have a trend line coming in there as well from higher up. Yeah, so I think the potential moves are a little underpriced. And I reckon dollar CAD could easily put in 100. If we get a surprise, well, we know what it is, right? It's either a double whammy for the CAD on the US NFP and the Canadian report, or we could get some saloon doors in there as well. So I wouldn't be surprised if we get a move down to 133, even 132.60, and then reverse on a very good number. If we break and hold this 133.85.90, 135, here we come, I guess.
Yeah, thanks for that trend line too. That's a good look that you're looking at there. And I was mapping this out in the ForexAnalytix community and daily roundup in the Morning Edge yesterday. We were just talking about, it looks really attractive to be on the short side up here. Why wouldn't you? If you didn't have a position, you'd be like, okay, I'm going to get short. And I think that, dollars, the US data is going to roll over. Canada is still strong, and, forget the fires, it's going to create more jobs because you got to rebuild more. Whatever anybody's argument is. The fact of the matter is this is kind of like the line in the sand, and, you can clearly see that the price action has been very bullish. And if you stepped in short yesterday or the last couple of days, your stops are right above here. There's a lot of, as you pointed out, K-Man, there's a lot of open air here. And if we start tripping stops above 134, you're talking the month of August, fairly illiquid, and people are just going to start to cover. And, you could really see a nice gapping move on a strong US data and weak Canadian data today. I'd agree with that. Ryan, do you have any thoughts on Canada moving forward into today?
No, nothing different to what you've just said. Same situation again. It's been pretty solid. Pointed out in the flow show in the last year, it's had 2 negative jobs numbers in the last year. So, another bout of strength. Just keep an eye on the full-time, part-time shindig, because there's been a good trend in full-time employment. You don't want to see that moving into part-time employment, even with a good jobs number, because that can indicate a bit of weakness there. But no, and you've got to watch it for if you're trading the loonie, as Kay said. This data can help dollar CAD go the same way, or it can put a bit of a break on what the US jobs does. So pick your levels, watch your stretch points, and if you can't break them, you know what to do them.
All right. Good ideas, and great commentary on the full-time data. Stelios, what is your trade du jour
favorite
today?
color?
No.
Favorite color. Oh. What is my sorry?
Trade du jour. What if this happens this is what I'm going to do trade. Like, you know, you see strong data, I'm doing this. Or if you see weak data, I'm going to do this. What is your trade setup you're looking for today?
It all
I
ends
think
in going down the beach.
You touched on a currency which is on the edge for me, which is dollar CAD. So if the data is strong, I think I think it's one of the currencies I want to be buying. So dollar CAD, because there is a trend line that we've just breached, and this level around 133.50, 133.70 has been quite important. So that's something that I think is definitely looking for a more upside, at least towards the 134.50. Let's say to start. On the other hand, if it's weak, I think gold with, he's been playing with 1930, 1935, which is huge support. Well, huge. It is big support before 1895. So if it's weak, then theoretically this holds, and we take another trip towards these highs at 1985. So I think those are the two that are closest. I always try to look at things that are kind of on the verge of either breaking out or breaking down, and usually on a number that surprises either way, these usually move, right? So
spoken like a true day trader. All right, hey, we're running short on time. K-Man, real quick, what's the trade? One trade you're looking at? I'm going to give you one out of, I've got many in my pocket, but I'm going to give you one. What do you think?
Real bad number. Dollar yen will probably hit below 142 and accelerate. Very good number. I will be looking at dollar yen is one. It's probably going to shoot, but a good number. I'll after perhaps an initial move lower on stocks, I'll be looking at buying risks in some or the other way. I actually have a Xena chip in the dollar CAD. I bought some option just to have a bit of volatility on the books.
All right, and you know that if you're in the ForexAnalytix trades room. Thank you very much. Dale, I know we got just about a minute. What are you thinking?
Sell rips and S&Ps to 45.40.
Okay.
So if the market likes it, I want to sell rips in the S&P, and I want to buy dips in the dollar, sell rallies in euro and pound.
By the way, it is.
I've got my stop at 45 in the S&P. So you can see it at 40.
I was gonna say, if you're trading around the S&P and you wondered why we bounced, it's no mystery where we're bouncing from and what we're doing. I mean, if you look at the S&P just from a purely basic technical perspective, we have channel support, 618 retracement, in an uptrend. Of course we're going to bounce there. Of course we're going to bounce there. That's why we're looking for channel support all week long to hold. It's held like a rock star. But now I think that the S&P is very, very clear. And I've got a lot of currency trades to give you guys, but those in the ForexAnalytix community already know what I'm thinking. So I'm just going to lay it out to you like this. I think the S&P is very easily laid out. Previous support at 45.25, that's your upside breakout point. And I think because earnings were, and Simon made this point in our chat room, since we had Apple that was, it's kind of trading lower, Amazon's trading higher, everybody's kind of hinging what's going to happen on non-farm payroll. However the market reacts, we're probably going to get a follow-through day. It's going to be a Friday kind of, we're going to go one direction and we're going to grind in that direction. Now, if we start breaking below 44.75 or so, that trend line, then get below that 618, which is right here at 44.67. That's when the as Paulie would say, the wheels come off the caboose. So with that being said, we were less than a minute away from data. Let me go ahead and get us all set up here. I'm going to pull up the dollar index over here. We have the S&P right here, and the dollar's all screwed up there. There it is. So there's the dollar S&P. We got yields on the 10-year. Let me pull up the data flash that's inside of ForexAnalytix so you guys can have that. Let me move that over, and I'm going to put the data flash right here. I know we have Canadian data, so I'm watching dollar CAD right there. Heads up, guys, we are less than 5 seconds away. Here we go. You guys ready? You ready?
Born ready.
Born ready.
Oh, 187.
Okay, in
Unemployment
line.
rate ticked down.
The dollar's firming up a little
Participation
bit.
rate is
S&P.
flat. Average hourly earnings beat on the monthly by 0.1. Can't see the yearly year on year.
Very,
Four
very.
point
Wow,
four.
dollar's really
4.4.
weak here. Why is it so weak?
It was due for correction.
Very, very flat Canadian report. Very flat.
Very flat.
Is
Yeah,
that-
you know, after the big beat and the big gain, I mean, you know, it makes a lot of sense. I mean, it's
Look
flopped
at the
all over.
revision. What was the last number of payrolls?
Not, I mean,
209.
Oh, it was 209. Okay.
Yeah.
So it's not a big revision. Okay.
This doesn't look like much. Unemployment rate was down. Participation rate stayed unchanged. Wages stayed unchanged at 4.4%. Was expected to fall 2 pips to 4.2. Average work week hours ticked down as well. It's a there or thereabouts report. There's no problems from the jobs market yet again for another month.
Yep. And I cannot get an
You got
order
that
off.
little bounce in gold
Geez, I
still.
just finally got some off here. Holy cow. I'm gonna update the
The
trades
options were
report.
right.
Yeah, low volatility,
Option
right?
traders were right. The volatility is low.
Yeah, it is very low today. That's right. Great eye came in. 10-year yields have come off just a little bit. You can
Yeah,
see
hardly
the
at all.
reaction in the S&P, you know,
A
then
dip.
yeah, I think the dollar gets bought on this dip. You know, I think I just bought dollar CAD actually. So right here. So just you know, just a heads up. I think you know, you're going to see a little bit of reaction. But what's going to be really interesting is how the market plays into this a little bit later. So you know, remember, it's a very long day today. It's very early, very long day. We got a gap down in Apple. We've got a gap up in Amazon. We've got the S&P flirting with channel support. You know, and it's still bullish. Let's not forget that the stock market is very bullish, but a break below 44.50 kind of changed the picture a little bit in the markets. Also keep in mind that the Mexican peso, I think, is the one to watch if you're talking currencies, because if we start to get a breakout above 1745, 1750, that's going to suggest that emerging market currencies are really coming under pressure, and you're going to see a bit of a reversal. So, but as of right now, I'm about ready to go get on the golf course. What do you guys think?
I'm about ready to hit the beach.
Yeah, I'm at the door.
All right. Well,
You asked for it.
yeah, I know. We asked for it. Damn it.
Well, I'm going to stay and listen to Michael because I'm a huge fan.
All right. Well, Michael is here, so I'm not going to take up any more of our time, but I want to say, Ryan, K-Man, Stelios, great job on the Flow Show, you guys. If you're not listening to those guys on the Flow Show, you should be. They're there every single day and early in the morning while most of us in North America are sleeping. But if you're in New York, you might actually, or in the West or East Coast, you might actually be up listening to these guys and trading. So make sure you're there. Dale, thank you for being here this week. Sorry your internet went out yesterday, but it was really nice to chat with Jamie McGeever from Reuters yesterday. I had a really wonderful time. So have a great interview with Michael Gayad, and Dale, take it away.
Okay, thanks, team. Thanks for another good week. And Michael, welcome to F.A.C.E. It's you know, hadn't talked to you for a few years, and now within 2 days we've had a chance to talk to each other. Welcome. Any initial reaction to what we have happening here on the NFP?
Well, first of all, I appreciate the invite, and I will say that for those that missed the interview I did with Dale yesterday through X/Twitter Spaces, was really phenomenal. I forgot, I hate to say it this way, but I forgot how good Dale is at not only communicating his thoughts, but also having original ones. So I kind of stepped in a little bit last minute. I just came back from the gym. I did not have this on my calendar, but I'm a man of my word. So when Dale reminded me that I said to come on, I figured I better show up. So
I blackmailed you.
Yeah.
Anyway.
So let's get into it. Yeah, it's so initial. First of all, as we know, usually the initial reaction with this stuff is probably the wrong initial reaction, right? It's not. You have to see how this plays out. I don't know if any of this is ultimately going to matter too much, and I say that because we are in this situation now where if Treasury don't start to stabilize, there could be some really nasty after effects on all risk assets, no matter how good economic data looks. Right. I mean, if you look at very simplistic, if you look at a chart on TLT, I mean, this week it looks like a crash. It looks like we've basically had another crash.
There's your weekly candle.
Right. So now some people just look at this and say it's a chart, it's like any other chart. It's not. Treasuries are the core to everything. Now, back in October, I was making the argument that I said the end of the world is the bull case. And I said that because the speed with which TLT was falling, yields were rising back then would have suggested that mortgage rates would have been like 20% in November. Had the yield rise in early October continued at that pace, it would have been catastrophic. And my argument back then was you can't bet on that. And then that's what starts to melt up in equities. The problem is you're now back at that point, and equities have nowhere near priced in the possibility of this yield shock that we may now be in when it comes to long duration Treasury. So I say all that to say that I think that if you're going to do anything from a trading perspective, you have to watch Treasuries in particular, because if they don't start to stabilize, I think it's a very, very nasty setup.
Yeah, look at those gaps, Michael. So you rarely see a market gap down like this. So, this is classic definition of trying to catch a falling knife. So they're called, about steady on this. 10 years up a couple bips. So 10 years making new highs for the move right here.
Right, the SP now is flat or is negative, right, undid the gain. So that's what I'm saying. Yeah. So this will be interesting because if let's say the knife stops falling, okay, if it stops falling as a new knife starts falling, which is the S&P, which is what I've been on the watch for. I keep referencing this point of, I call it the flippening, right? I always try to find terminology. The flippening meaning, where you see intraday a big decline in stocks and Treasuries rally. Right. So this goes back to kind of my world from a risk on, risk off perspective, which has really been challenged the last year and a half. But, Treasuries in high volatility sequences act like a short on equities without the risks of shorting. Right. Meaning you can see that you look historically at major declines, you'll end up seeing, periods where the SP is down 2% and TLT is up 2%. Right, because it's just that flight to safety dynamic. So that sequence, that flight to safety, that Phoenix rising, that flippening, all these different analogies I use, that I think is the thing to watch out for, because as I keep referencing, the conditions favor a tail event here from all the intermarket work that I do. I laid it out on my pinned tweet. I don't think anybody is anywhere prepared for what could be a credit event. And by the way, the Treasury markets may be starting to tell you that something's happening on the bond side. And it's happening. All this, by the way, is happening with everybody on vacation, which is often the way this stuff happens. Right.
Well, Michael, I look at what happened in 2022, and it was a decline in the stock market. We had 30% sell off, and during that we had very little flight to quality. In fact, the bonds led the decline in the stock market. So, even I think that there could be a flight to quality rally in bonds, but, that would mean a reversion to the way things used to be. And maybe they're both bad together and both good together, because people were not protected in 2022 by having 30% in bonds. It turned out to be a bigger loss than their stock portfolio. So
and I will say,
why is it going to change?
Yeah, because yields are higher for one, right? And I think I'd argue that last year was an anomaly, not just in terms of stocks and bonds losing money, but rather in terms of the way in which it played out. Last year was like a controlled implosion in two asset classes that tend to act counter to each other when there's an implosion. Right. So that whole sequence, I'd argue, is what was the anomaly. But your point about kind of going back to the way that it was, by the way, that argument of the way that it was goes back to even prior to the bond bull market of the early 80s. I always go back to on the point you just referenced around Treasuries losing more money than equities. In 1968 to 1970, you had a major drawdown for stocks. Treasuries, if TLT were around back then, it would have been down around 14, right? If it would have been down around 14% in the midst of a 32% drawdown for the S&P. Both
Right.
asset classes were terrible in the context of that equity drawdown, but Treasury still looked like the better place to be on a relative basis. So you don't have to necessarily go back to the perfect, kind of flight to safety dynamic that we saw post Volcker, but you can certainly go back to a period where Treasuries on a relative basis meaningfully outperform equities. Now, how would that happen? Because yields are not going to really collapse in a massive way. It would happen with stocks doing the heavy lifting on the downside.
Okay, and we talked about this briefly yesterday, but what's been happening in corporate and junk actually having not a bad looking structure. So can you explain why money flow prefers junk to sovereigns?
That's,
I mean, can anyone explain that to me?
it's hard to explain. First of all, you can always explain anything with any kind of narrative, right? That's always what is kind of the joke about this industry. But you're hitting on something which is why there has to be a great readjustment, because it doesn't make sense. Like the argument that, for example, somebody sent me a tweet, he then deleted it yesterday, saying Apple is safer than U.S. government debt. And I said, this is complete insanity. Okay, Apple does not have a military. Okay, Apple does not tax. Okay, and it's like
they have one in the metaverse. If you put the put the goggles on, you can imagine.
Yeah, exactly. But that's my point. It's like you're telling me that if the U.S. government, if its debt rating keeps getting downgraded, you're telling me they're not going to tax the ever living hell out of Apple and every other company to try to counter that? Right. I mean, it's a silly concept. But that's the narrative of the moment. That's what justifies. I'm using that as an analogy to justify the junk debt.
Well, you know what I tweeted on that subject? That the people think Apple's a bond, Michael. I said, well, they could end up being correct if Apple crashes like the bonds did.
Right.
Then they're right.
Right,
it was a bond.
Right. Exactly.
But money, and we're going to gap lower in Apple today. So. I'm just wondering why money managers are going to junk over sovereign. They have more confidence that junk is going to pay off more than the U.S. government when we have the printing press. I'm just trying to get my head around it. I've been watching.
It's mind-numbing. It's mind-numbing. I said this last year. Obviously, I was very early, but I do maintain this idea that it's only a matter of time until a duration crisis becomes a credit crisis. Right. So you haven't had the credit crisis yet because spreads are still very tight, and you haven't had that VIX spike that typically is the marker of the end of a bear market, right? The capitulation. You didn't have that in equities, right? So, which is why I keep going back to I still think we're in a bear market, right? I could be wrong, right? I know it sounds crazy, but
we never had the capitulation. We need like a 40-50 in the VIX.
Yeah, and that tends to mark the end of it.
To happen.
Right.
So maybe we're starting it. This week you have a little reversal week this week, and pretty good action if we hold above all the averages here, but I can make a case for 48 if I get what I think is going to happen in the market. We never had the capitulation in 22, and now I think that the market is long enough for that to happen.
Yes, correct. That's right. Which is why I keep saying no one is prepared. That's why I keep saying it has to. Not only does it have to, I'd argue, come from left field, right? Because I keep going back to the way that last year played out. Really, I think messed with people's perceptions of how markets decline, because it was very controlled. It was very gradual. It was not an elevator down, it was a staircase down last year, right? So in order for the market to shock the public back into the way markets tend to work when there's left tail risk, it has to be very sharp. It has to be very sudden. It has to be something that you can't necessarily position for based on some trend line, right? So that's why I keep saying it's a credit event. Event implies something that it happens in a compressed period.
Okay, so you think part of that is going to be what happens in U.S. dollar yen? Can you explain? Now, this is a number I was talking about, the 42 number yesterday, Michael. And I also said that there'd be a relief in the dollar. I thought the dollar was oversold and we'd have a little pullback. So that's adding a little, support to the stock market short term. Nothing major. S&P's up 7, Nasdaq up 28. But the yen, I wanted to give you the macro look. First of all, back under 42 is not going to be good,
Right.
but under 138, it sets up this kind of move. And tell me what this would do to the stock market. So here was the high last fall. BOJ was intervening. Fed was jawboning to help the deal out. Had the big break, putting in a lower high here, came off, putting in another lower high. So if you just have equality here, from here, it takes you down to 120. What's going to happen to risk in a situation like that?
Well,
and why would that happen?
First of all, I would argue that as that's happening, cannabis sales are going to skyrocket. Because
Okay.
everyone is going to want to get high to escape the stress of a declining market and high volatility period.
I don't need that. I don't need that
No.
excuse.
Of course, I'm kidding. But the point is that no, I mean, it goes back to the carry trade dynamic, right? So if you end up having the yen rising, which is consistent with which would be the dollar yen falling, obviously, that ends up happening against the leveraged positioning from a carry trade perspective, that unwinds and causes a forced global margin call, which we've seen historically. So, people forget the yen, is also a risk off play.
Yeah.
Right. I mean, there was a period there with Abenomics where that broke, but prior to Abenomics, that was the case. When you have high volatility, the yen would rally. You'd have repatriation from investors back to Japan and selling off of other assets, which includes U.S. equities, in particular tech. So all that is still consistent to me with the broader risk off period. Dollar euro, right, would rally. Dollar yen would not.
Okay. So we're getting a little bounce in the euro. I'm still constructive on the dollar. Any other topic that's top of mind? I know you want to get ready for the opening. Did you want to talk about Bitcoin? You asked me about Bitcoin. I was surprised you did. So I'm curious what your view is on that asset class.
Yeah, I mean, look, I tend to be a natural contrarian, which, by the way, has nothing to do with my funds, because, again, the rules-based, I have to keep on emphasizing that for those that can't differentiate between me as a fund manager and me as a thought leader. But, the thing everyone assumes is that Bitcoin keeps being correlated to the NASDAQ. Now, if you have a sovereign debt crisis, I'm pretty sure Bitcoin was built for a sovereign debt crisis. So it kind of makes sense that if you're going to have a credit event, and if you have a reversal of a carry trade, and you have further downgrades of government debt, like we saw with Fitch, right? Yeah, that seems to be like the exact kind of perfect storm for Bitcoin to diverge, right, from other risk on assets. So we'll see. It's like you always have to think in terms of. I think you always have to think in terms of what is the narrative that people will be will strongly argue for after the fact. Well, like, you have to kind of imagine what's the chapter that will be written. And the chapter will be written if you have a sovereign crisis, then Bitcoin diverges. But nobody sees it yet because it's not in the historical correlation.
Well, how about the duration risks being exacerbated with what's happening with treasuries and all the banks that still have duration risk on the books? I talked about yesterday, PacWest Bank going under. They didn't even write about it. Some bank just took it over. Heartland Bank. I would think after the move in yields in the last week and a half that these banks are even under more pressure.
Oh, there's no doubt. There's no doubt. And this is why it's like, how do you not have a credit event then? So, the suddenly now, that implies what? The yield curve probably gets even more inverted. Okay. And, the lending gets even more constrained. So I keep using that line, slowly, then all of a sudden, slowly the credit side keeps on, not being as aggressive in terms of how much is out in the economy, and then suddenly it looks like it's almost completely stopped and turned off, and then it's like, all right, well, suddenly you have a tail event. So look, I'm not trying to be a perma bear by any means, right? I mean, it was very aggressive saying melt up, and I've been at this game for well over a decade on the content generation side, analyzing markets. When I see so many people assuming that we're in a new bull market when they seemingly forgot we went through the fastest rate hike cycle in history, which from a lags perspective starts to hit now, that's when everyone should start to get really nervous about the assumption that the future looks like the past.
And recall when Paul started on the tightening regime, everyone said that, he was going to tighten until things broke.
Yeah.
Well, SVB was the system breaking, something breaking. Okay. Even though they patched it. And yet he continued to tighten after that. So I guess that's no longer a, red line. That it's okay if things break. That he's
Well,
going to continue.
you make a good point, right? Because like you can argue things have been breaking just from bankruptcy filings that are picking up, right? The thing that has not broken is junk debt, is this, which goes back to credit spreads. That's coming.
What would it take?
It's a good question. I mean, the catalyst is only known with hindsight, and again, I think it's the carry trade that just kind of unwinds the leverage. But that's the thing. It maybe still is going to be a delayed effect from Fitch. Maybe there's something else that happens, right? But when the tinder is dry, it doesn't matter what lights the fire, right? All you know is that the risk is there to get burned, right? So that's why I would say it's more about conditions rather than it's this or that. I happen to think it's going to be the carry trade unwind. It seems almost too perfect because it has to be something that it's almost a little bit hard for people to understand. It's not intuitive to think about how Japan is a big, not a butterfly, but as a Mothra when it comes to global markets.
Okay. Jane, you have a question? I wanted to show where people could get Michael's work, lead lag report. That's also his Twitter handle. Has a lot of subscribers. You can, check it out for free and then upgrade. So all you have to do is this and you'll get it. So check out Michael's research. He's one of the greater thinkers in the markets. No one's perfect, but I consider what Michael is looking at in the market to pay attention to and include it in my intelligence gathering. So Michael, last thoughts going into this August season where bear raids are, if they're going to do it, what great conditions with everyone in the Hamptons.
Yeah, right. Exactly.
Huh?
It's true. Is if not now, when?
Yeah, because they'll come back after Labor Day. Maybe they come back to a different looking board.
Yeah, I mean they'll still be rich. I mean, that's the frustrating thing. Right.
Yeah, well, they will still be rich, but maybe their stock portfolio might take a little ding here. Right. Anything you're worried about overseas, geo-wise? Does that factor into what you think with what's happening in Ukraine or what's happening with China? They're launching a new currency. I hope that's all they launch at the end of this month. And anything that you kind of keeping an eye on that keeps you up at night?
Well, I wouldn't say it keeps me up at night, but I put a tweet out saying plot twist Brazil. Right. Okay. And that was yesterday. And, Brazil was the pretty much the earliest central bank to raise rates way before the Fed. Now they're starting a cut cycle. So if Brazil is maybe with the Selic a bit of a leader, oddly enough, in terms of reacting to inflation, disinflationary pressure, their pivot might be first. The Fed's pivot might be, obviously with the delay. And I keep going back to that point that Fed pivots are usually not good. That's often when the drawdowns, start to occur because it means the Fed already over tightened. So we'll see. Okay. There's it's an interconnected world, and nothing is that simple.
And also, Michael, a lot of people were moving away from the U.S. looking for outperformance in Europe and emerging markets. And you look at the DAX and the Nikkei. The DAX is already, looks to me like it's broken down, and the Nikkei is right on important support. And I'm thinking if the yen does take out 142, Nikkei will break down too. So, could that be a trigger? Something from overseas? They led on the way up. Maybe they lead on the way down here.
Yeah, it could be. And I'll tell you, the emerging market side is always a sore point for me because, my mutual fund ATAX tries to play risk on with emerging markets from a rules-based perspective. And it's like death by 1,000 cuts. Every time it looks like EM wants to run for the last decade, you get a momentum signal. It just doesn't want to stick. Right. So I think that has all kinds of other implications also, permeating to Europe.
Okay.
I think the Eurozone is far more of a problem for the world than anything else very long term. But the leverage is not anywhere near as high as what's being created by Japan.
Okay.
But yeah, I'm with you. I think I think the point on this whole discussion is you have to go beyond the home bias and in thinking that it's only about earnings and thinking it's only about the U.S. market.
Yeah, there's a global thing happening here.
Yep.
Okay. Well, I'm glad you're on the planet, Michael, and I have a chance to talk to you. I really appreciate you dropping in on a busy day. I encourage people to go to your Substack and sign up for the Lead Lag Report, and at the minimum, follow Michael at Lead Lag Report on Twitter. So thank you, Michael, my trading warrior brother. It's great hanging out with you this week.
I appreciate that. All right, we'll be in touch.
All right. So that's a wrap, everyone. Could join the team in 20 minutes on the Morning Edge. I hope you enjoyed Michael. I know that I love talking to the guy. I could ask him anything. So have a great weekend, everybody. Don't just count your pips, count your blessings. See everyone Monday. Thank you, team, for laying it all out on the court and doing your best to keep people on the right side of things.